before we start, we'll just take a minute to talk about because this is the first time we're speaking with a lot of you guys. So just take a minute to talk about uh, the reason we're doing this. So John and I have worked in business and investing for almost 10 years now, which has been some time, and we're very passionate about it, if you can't tell. The best way to kind of test if someone really is passionate about business and investing is the first thing that John and I think when we go into a restaurant. This is the restaurant test, is we'll go into a bubble tea store and we'll be talking about this is how much we think the shop is making, whether it's interesting to buy a bubble tea store, whether it's interesting to invest in one. So we really enjoy investing, but I think one of the unfortunate things about investing, especially on Wall Street, is a lot of what you do is you're investing for wealthy white families, and you're mostly earning money for their grandchildren's grandchildren. So that can be a little bit um, disappointing, I guess, over time. And in the meantime, we found out that our parents were being sold a lot of financial products. And generally, at least my opinion was some of the products were not always the highest quality. So that was just a little bit disappointing when I found out that. And over the long term, I think it'd be great if we could figure out a way to invest on behalf of Chinese families as opposed to wealthy white families. But for the moment, we haven't quite figured out how to make those economics work yet. So we've been trying to do the next best thing, which is basically financial education, because that way you guys can go out and assess the investments yourselves and do retirement planning yourselves, and then go out and just be well educated and do those assessments and then tell your friends. And that way the word kind of spreads out through the Chinese community so that everyone is kind of well prepared when they're assessing investments, and also when they're thinking about retirement as well for a lot of people. So that's the reason why we started doing this. It's only been, I think 2 or 3 weeks now, right, John?
Yeah.
And it's been really great because we've gotten a lot of support. I think there's now 700 plus people across a few WeChat groups, and it's just pretty meaningful to be able to do something like this and reach more people, and then 700 people can all tell a friend, and then we've reached 1,400 people, and we can just spread the education that way. So that was just a little bit of an intro, but I want to kind of jump right into the two topics today because these are pretty intensive topics. Let me share my screen here. Okay. Slideshow mode. Let me make this a little bit smaller. Okay, perfect. All right, so today we're going to be talking about two topics. These are pretty time-intensive topics. We will try to simplify them as much as possible. During the presentation itself, I think the best thing is if you can add the questions into the chat, because there's a chance that we'll answer the questions as we're going along. And then either me or John can just stop if we see everyone's asking the same question, because then we'll know that I've said something or John said something that's confusing. The two topics are: when should you collect Social Security, and when should you convert pre-tax to Roth IRA? These topics are best talked about together because the Social Security topic directly impacts when you should convert into Roth. So the first of the two that we should discuss is when should you collect Social Security? And there's a couple parts to this. And by the way, I'll kind of try to hit the basics very quickly on all of these topics, just in case, but some of it might be repeats for people who are more experienced. But I'll try to make sure we cover everything in a pretty quick fashion. So Social Security is basically a monthly amount that you get paid by the US government. You get paid your primary insurance amount monthly. And the primary insurance amount, you can find that amount on the Social Security website. Once you're getting close to retirement age, that amount should be pretty much locked in. And the easiest way to see what it is actually to go onto the Social Security website. And the reason that amount is important is once you reach your full retirement age, which for most people, if you were born in 1960 or later, your full retirement age is 67. Once you are 67, you can collect 100% of this monthly primary insurance amount as part of Social Security. Now, you can also choose to collect before or after your full retirement age. So remember, if you're born after 1960, your full retirement age is 67. So let's say your primary insurance amount is $2,500. If you collect earlier than 67, you'll collect a smaller amount, and that's a percentage. You can see those percentages here. For example, if you collect at age 62, you're only collecting 70% of your primary insurance amount. So that's $2,500 times 70% gets to $1,750 per month. If you wait until age 70, you collect more. So if you wait until age 70, you'll collect $2,500, which again, this is just an example primary insurance amount. Your actual one is on the Social Security website. If you wait until age 70, you'll collect 24% more. So that's $3,100. So I think one thing that's important to highlight is it seems like you would almost for sure want to wait until age 70, given it's a larger amount. But keep in mind, for example, if you pass away at age 70, you collect nothing, right? Starting to collect at age 70 means you give up the potential to collect from age 62 to age 70. So there's actually a couple different factors that go into when you want to start collecting. One of which we just touched on, is probably life expectancy, right? So let's go into a couple other rules. And these are just rules to show you before we get into the actual Excel sheet. A couple other rules you should know is if you are married, you can choose to collect your spouse's Social Security if your spouse passes away first. So the reason you do this is if you have one spouse with a higher Social Security amount and they pass away before you, you would basically get their higher benefit. So that's also one factor to keep in mind when deciding when you want to start collecting Social Security. And I'll go into how that impacts it in the actual Excel sheet in a moment. The second thing is if one of the spouses has an especially low primary insurance amount, you can choose to collect 50% of your spouse's Social Security. So this might happen if, for example, either the husband or the wife is a stay-at-home dad or stay-at-home mom. In that case, your primary insurance amount would potentially be quite low, in which case you would be able to collect 50% of your spouse's Social Security. Okay, so those were just a few general rules, but how to actually, I think one of the points we want to talk about today is how to actually determine when you collect any of these things are very situation specific. So I don't want to give too many general rules. Instead, what you should do is use some of the calculators we have in here. So this sheet has a few different tabs, and the tabs serve different purposes. The first tab is a Social Security tab. This is tab 1, Social Security. So how to, I guess a couple of things about the sheet. We try to make it as simple as possible. So sometimes things are estimations, right? It's not going to be very precise because it's more important to make it usable for everyone. So how this sheet works and how all the sheets work in here is there are sections with this kind of yellow highlight and blue text. Those sections are inputs. So the reason you have these inputs is this allows you to put in your specific personal information. So for example, again, we had talked about some of the factors that matter for Social Security. One of the factors that matter is your current age. Another factor that matters is your life expectancy. A third factor that matters, your primary insurance amount. This amount comes directly from the Social Security website. So these are, again, this is your actual age, your best guess on your life expectancy. Your primary insurance amount, that comes directly from the website. Then there's return on investment, which is, this is the expected investment return you earn on cash. I'll talk a little bit more about this in just a minute and why that matters. And then down here, finally, is this is once you enter in this information, you can try out different ages when you start collecting Social Security, and then you'll see the impact. So let's just look at this situation here. The husband is 62, the wife is 60, and you both start collecting at age 67. So how does that look? If you look at this table, you have the current year, the age of the husband, the age of the wife, and then the Social Security benefit. So let's say, for example, again, like right now, you're 62, the husband is 62, the wife is 60. You both start collecting at age 67 in this example. So based on this, in this year, the husband turns 67, he starts collecting Social Security. That Social Security amount, in this case, is again $2,500 times 12, which gets to $30,000 a year. The wife, she turns 67 slightly later. You can see here. At this point, the wife turns 67. She starts collecting $2,000 times 12 per year. That's her Social Security benefit. Now, you can change these toggles. So let's say the husband starts collecting at age 62 or 63. So you can see here that this changes the amount. It changes both the amount you collect as well as the age you start collecting. So you can see this amount is less, right? If you recall, if you collect earlier, the amount is less. This is 22,500 versus 67 is 30,000. This is basically taking into account this table we looked at together earlier. If you start collecting at 62, you collect a smaller amount. So this will automatically calculate how much you collect based on the age you start collecting. And then what we can do is we can look at the total Social Security benefit. So this is what we want to maximize, right? We want to get the maximum number here possible from summing up every year of Social Security benefit. You can see here as well, remember the spousal factor we had talked about, which is when one spouse passes away, the other spouse inherits the higher Social Security benefit. In this case, the husband's life expectancy was age 90. This is the husband's age. This is his life expectancy in this input box here. So at age 90, what's going to happen is the wife will start collecting the higher Social Security amount up to her life expectancy of 95. So that's how this calculation works. It will automatically fill this in for you. And what you can do then is once this is automatically filled in based on the different ages, is you can look at what the sum is. So this is actually going to be a sum of all the Social Security benefits collected by year. So again, we want this to be as high as possible. So how this sheet will work is you can try out different ages. For example, if you both start collecting at 62, remember, if we're both collecting at 67, the amount is 1,458,000. So it's a little under 1.5 million. Do 62, 62. Now this amount is 1.2 million. So that's about 300,000 less. So that's how this calculator works. This is again a sum of the total amounts here. So you can try out different ages. You can try 70. Now it's 1.6. So this amount is now higher than it was when they were both 67. And again, I don't want to, it's all very situation specific, right? Because, for example, if your life expectancy is 75, then you probably just, if we take a step back and think about it theoretically, if your life expectancy is much lower, you probably want to start collecting earlier, right? But you can actually test that specifically by changing the numbers here. This is, if you start collecting at 70, it's 416,000. If you start collecting at 62, this number goes up. And that makes sense because probably when life expectancy is lower, rather than wait till you're 70 to start collecting, you probably want to collect at an earlier age. But it really depends on the specific circumstances. So it's best to use this sheet with your exact expectations as opposed to giving you guys a general rule around this.
Hey, Nick, maybe one concept that isn't as intuitive for everyone on the call is, can you just explain net present value?
Yes, yep, for sure. So net present value. So the best way to explain this is $1 today is worth more than $1 a year from now. And the reason that's the case is if you're able to invest the dollar today and you earn a return on investment of 3%, a year from now, that dollar is worth $1.03, right? $100 today is worth $103 a year from now if your return on investment is 3%. So what net present value does is it basically takes into account that you can earn a return by getting money earlier. So this might be a reason you potentially want to collect Social Security earlier, right? If you collect at age 62, you could potentially invest that money and generate returns on that money. So what we do is we show you two ways of thinking about your total Social Security benefits. The first is just your total cash amount. This is just the absolute cash dollars you get during your expected lifetime. And the net present value takes into account the return on investment. So let me just give a theoretical, taking a step back, if we just think about this again, if your return on investment is very high, then might want to collect earlier. So I know this is unreasonable, but let's say, for example, your return on investment is 30% per year. So what happens when your return on investment is 30% is, again, like here we have the situation of both collecting at 62, but let's say instead we collect at 70. Do you see how that net present value number actually goes down? So even though so this cash value goes up, 62, 62, it's 1.2 million in cash, but 100,000 in net present value. But at 70, the total cash amount you're collecting goes up, but the net present value goes down. And the reason that net present value is actually going down is because if you're able to truly earn 30% return on investment, you might want to actually collect Social Security earlier because you can invest that and make more money with it. So this is just two different ways to think about when you want to start collecting. One is just absolute number of collections. The other takes into account the time value of money, which is money collected earlier is worth more than money collected later, especially if your return on investment is very high. So this is Social Security. It's just go through the inputs, and what will happen in a moment is when you collect Social Security is going to feed into potentially when you want to convert your Roth. Okay. One final note on Social Security is Social Security is most likely going to be taxed for you. The reason for that is once your combined annual income is more than $44,000, then you'll be taxed up to 85% of your Social Security benefit. And for most people, either through interest, rentals, or once you reach 73, once you're getting required minimum distributions from your IRA, very, very likely your income is going to be greater than 44,000. So just keep in mind the Social Security amount you get is not 100%. It's going to be taxed. Okay, second topic. When should I convert to Roth IRA? The first thing to keep in mind is any pre-tax, and by the way, I will use 401k IRA interchangeably, so just keep that in mind. Every pre-tax IRA will be taxed at some point. It could be taxed if you withdraw. It could be taxed if you convert into a Roth. And sometimes you'll be forced to take those taxes because you must withdraw or convert due to required minimum distributions, which start typically at the age of 73, or your beneficiary must withdraw. If they inherit a pre-tax 401k, they have to withdraw within 10 years of inheritance. There are a few exceptions. For example, if you donate a pre-tax IRA to a nonprofit, nonprofits don't have to pay income tax. So that's a scenario where you might not be taxed. But in most cases, you are going to take those taxes on an IRA if it's pre-tax at some point in the future. If possible, second concept, if possible, you would prefer more money in your Roth. Why is that? Because your Roth can grow and have gains and income which are exempt from taxes. So more money in your Roth is preferred. So if you can use money outside of your Roth, for example, your individual investment account, you should spend that money first. Similarly, if you are able to convert your pre-tax to a Roth, instead of withdrawing the pre-tax amount and spending it, you would prefer to do the conversion to a Roth because, again, the Roth gets to grow, its gains are tax-free. So what factors influence when you convert? These are three of the most important ones. The first is when your income is the lowest. So we'll go into this in a moment. The second is, will the income of your beneficiaries be higher or lower? And the third, excuse me, is, will tax rates change in the future? So let's talk about these one by one. The first is, the reason you want to convert when your income is the lowest is that's when your tax brackets are low, right? So you'll be taxed less on the conversion. So there are periods of time where you have lower income. One of the key marking points is retirement. Once you retire, you're not earning a salary, your income is lower. On the other side, once you reach 73, there's required minimum distributions, which is essentially forcing you to convert/withdraw from your pre-tax IRA. So at that point in time, you have to convert. So you will be recognizing income tax once you reach that age. And then in between that, there are periods of time where you might have lower income. And that's going to depend partly on when you should start Social Security, which is why doing Social Security first is important. And there's also some other factors like Medicare, income limits, and that type of thing. So we'll talk about that in more detail in the actual Excel sheet. Very quickly.
That's a good point to address one of the questions in the Q&A. Just so everyone understands, if it's a specific question, I'll try to answer it with you directly. But if it's a question that's applicable to the broader group, then I'll ask it to Nick, and we can talk about it so everyone is aware. So Nick, one of the questions in the group is there a latest age to collect Social Security?
Yes. So if we go back to well, there was that table earlier. Let me show you guys. That for most people, sorry, go ahead, John.
No, I was going to say, I think the punchline is the scale ends at 70. So you can continue working and push back the collection date, but it won't go above, again, in this example, 124% of the PIA.
Yes, that's right. And this is specifically for, I'm hoping this is, and maybe not, but a majority of people, if you're born after 1960, this table is specific for you because it's the full retirement age is 67 if you're born after 1960. It could be slightly different, not too different, just slightly different if you were born earlier than 1960. But yes, you'll max out once you reach 70, that's as high as it starts to grow. So you want to start collecting at that point in time. Okay, where was I? Okay, yes. So we just talked about why you would want to potentially collect during low income times. The other thing to keep in mind, to keep in mind is you want to keep in mind your beneficiary's tax rates, because when a beneficiary inherits an IRA, if it's pre-tax or if it's Roth, they have 10 years to withdraw. So say, for example, they inherit a $1 million pre-tax IRA. In that case, likely what your beneficiary, if it's your kid, for example, would want to do is, rather than draw $1 million at once, they probably want to spread it out, draw $100,000 plus maybe it's earning a little bit of return along the way. So if you think about it, if they're already working and they have a salary, that means that $100,000 that they're withdrawing from pre-tax IRA is going to be taxed at their highest marginal tax bracket because it's an addition to their income. So you just have to keep in mind what your potential beneficiary's tax bracket is versus your own tax bracket during retirement. If, for example, your child inherits a Roth, very likely they want to wait until the end of 10 years to withdraw the entire thing. Because remember, Roth, the gains are tax-free. So you want to earn tax-free gains as long as possible before you withdraw. The final factor, which we'll only spend a little bit of time on, is will tax rates be higher in the future? The Tax Cuts and Jobs Act was passed in 2017 and took effect in 2018. And you can see here how it impacted taxes. If we compare $100,000 in 2024 versus 2017 before this act was passed, you can see the marginal tax rate is 22% if you're earning $100,000 in 2024 versus the marginal tax rate was 25% in 2017 before this act was passed. Now, this specific act sunsets at the end of 2025. So by 2026, if this specific law or something similar isn't created, then that means we are going back to higher tax brackets, very likely. Now, what would it take to potentially have this law extended? It may require, if you remember what the situation was after the 2016 election, Republican president, Republican House, Republican Senate. So it could be a situation where that has to happen in this year's election for us to continue extending these tax rates. Maybe not. We'll have to see. I think this is very much in the air, but it's just one of the factors to keep in mind. Okay, so that's some of the general principles around this. But I think one of the things that John and I really want to iterate is for these things, you really have to just put in your specific details to make sure you can figure out when you want to convert. So we were just in the Social Security tab. Now we're going to go to this to RMD calculator tab. Excuse me. Sorry, we just had dinner a little while ago over here. So in this tab, remember required minimum distributions are required withdrawals from your pre-tax IRA once you reach the age of 73. So this sheet specifically, and by this sheet, I mean this tab, calculates how much your required minimum distributions are going to be. And the inputs here are, again, it's not too complicated. It's just your current IRA value. So add up your 401k, any IRA accounts you have, just group them all together. That's fine for husband, wife, and return as well. This is how much you think you can earn in your IRA. So in this case, I've just included a pretty conservative 3%. And if you go down here, you can see this is the husband's total pre-tax IRA, and this is the wife's. The husband's starting value was 800,000, right? That's coming from here. So 800,000, it's earning 3% a year. So we want to make sure we take into account the fact that the IRA is going to be growing a little bit over time. And you can see there's the two ages. Once the husband turns 73, he starts having required minimum distributions here. And the formula it's not too complex, but I don't want to go too much into detail. Basically, how it works is once you reach a certain age, there's basically required distributions, and this formula will automatically calculate what that amount is for you based on this table. So you can see here, once the husband reaches 73, here are the required minimum distributions. Once the wife reaches 33, that's here. Here's the wife's age, 33. There's again required minimum distributions. And you'll see the reason we have these in a moment. It's because it all feeds into when you potentially want to convert your Roth. But the other thing to highlight here is here we also show the total required minimum distributions. It's just the sum of this row, as well as at the very end, even though there are required minimum distributions, remember we had inputted in the Social Security sheet the life expectancy of this husband and this wife. We have 90 for the husband. Even with the formula for required minimum distributions, there's still an amount that of pre-tax IRA that's left over, that this is now what the beneficiary is going to inherit. So in this case, it's about 1.3 million that will be inherited pre-tax by the beneficiaries. And part of the reason for that is we don't have any Roth conversions right now, right? We haven't converted anything. It's just what is absolutely required by law to be withdrawn. So we're going to go into this in a moment, how you can test out different conversion amounts. And that's going to be in this tab. It's called 3 Roth conversion, this tab here. You just go directly in order when you're working in this Excel sheet. So in this tab, Roth conversions, here's where it gets very person specific. This is why it's so hard to give a general rule around when to convert. It depends on basically what income you're earning in any given year. So if we look at this situation, this is 2024, right? We have the husband, the wife. Here we have the salary of the husband. So in this scenario, the husband retires at age 65, the wife retires at age 60. You'll want to put in your specific information in here so that it calculates it. We have things like rental income, interest income. And again, this doesn't have to be perfect. This is all a bit of an estimation, right? You don't know what your income's necessarily going to be in 2027, but it will give you a sense of how much to convert and when. So you have these different income sources, and all of this adds up into ordinary income. You take out the standard deduction. Again, this is all, there is a probability if you're donating a lot of money in a given year, maybe you're not taking the standard deduction, maybe you have larger deductions. So please do make sure you change this depending on your personal situation. And then down here, after you calculate your income, this now calculates your tax. And you can see what tax bracket you're in, what your marginal tax bracket is. So you can see in this situation, there are specific years where your income, this couple's income is very, very low. And those are the years when you should potentially explore Roth conversions. So here, for example, this couple's in the 10% ordinary income tax bracket because they're retired. And if you think about that versus potentially your beneficiary's tax bracket, your beneficiary might be in, well, I would say would very likely be in a higher tax bracket than this 10% tax bracket. So how this all comes together is once you've entered this information, now we just focus on the Roth conversion amount. And when we change the Roth conversion amount, we can look at how that impacts this up here, your total taxes paid. Now, the total taxes paid consists of 2 different things. The first is your lifetime taxes paid, which is just a sum of your total income tax. But in addition to your lifetime taxes, there's also your beneficiary's taxes, right? So you have to make an assumption about your beneficiary tax rate. The best way to do this is you can kind of look at I mean, it's more art than science because you have to predict your, for example, kids' future tax rate. But you can
Hopefully it's high.
probably, so yeah, hopefully it's high, but maybe sometimes it might not necessarily be. I mean, maybe if you live long enough, your kid has retired. So there's always like very different situations. Um, but in this case, there's a decent chance that it's probably something like 24%, maybe lower, maybe a little bit higher. And what happens is this inherited pre-tax IRA amount, that's from the RMD calculator, right? Remember, there's some left over here, and that goes into here. And then you apply a tax rate to that to figure out how much tax your beneficiary is going to pay. And then you add your lifetime taxes and your beneficiary's taxes, and that gets you to a total taxes paid. And now what we can do is we can experiment with conversions. So let's look at this, right? This is about 950,000. What happens if in this lower tax year, where you're in the 10% bracket, you convert 50,000? Remember, this a moment ago was 950,000. This means you've just saved about $15,000 in taxes. Let's now take this. Let's say the wife also converts 50,000. A moment ago, that was 935,000. It's now about 920,000. You've saved another about $15,000 in taxes. Again, this is one of these years, but what you want to do is you want to look at all the years where your income is lower and drag it right. Maybe even in some of these years, for example, here you can see, the reason this is going up higher, your income, it's because of Social Security, right? The husband has turned 70. Remember, we had decided the husband and the wife would start collecting Social Security at age 70. So your income has slightly gone up, but it's still pretty low, and maybe it is lower than your child's or beneficiary's future tax bracket. So you can play around with more conversions. Oops. And remember, when we started, this number had been $950,000 in taxes. And you want a lower number here, right? You want to pay less taxes. So you can keep on playing around with these numbers. And similar to the Social Security sheet, except the Social Security sheet, you want more Social Security benefits. For this sheet, you want less taxes. So what you're basically doing is you're playing around with the conversion amounts to figure out how to make these numbers as low as possible. This had started around 950,000, right? This is now around a little over 800,000. Now it's under 800,000. We've saved about $150,000 in taxes by doing some of these conversions. Now, similar to the Social Security sheet, there's also that concept of net present value. So there's two ways to think about it. The total taxes you save in terms of cash amounts is one way to think about it. The other way to think about it is cash is worth more today than it's worth in the future. If you pay more taxes today, that means you have less money to potentially invest today, which means you probably, if possible, things being equal, would rather pay taxes in the future. So again, it's two different ways to think about it. One is just minimizing the total cash tax amount, and the second takes into account your rate of return. And potentially you want to think about making that low instead, especially if you think you can invest money at a high rate of return. So again, it's just two different ways to think about it. And what you basically want to do is play around with this and figure out what can get these numbers as low as possible. I mean, just here we've gotten, I think it was 950,000. We've saved, about $170,000. Sorry, yeah, $170,000 in taxes. So that's a pretty extreme amount of savings just because we're converting during these years when income is low. And there's probably other opportunities here as well, but we won't spend too much time on going just playing with these numbers. The important thing is just to understand you want to fill out all your information here, and then you can start to play around with when you want to convert. One final thing I want to spend 5 minutes on. Just want to spend 5 minutes on Medicare. So Medicare premiums, just as a very basic understanding, Medicare premiums are what you have to pay to get Medicare, and there is an income adjustment related to Medicare premiums. It's called the income related monthly adjustment amount, where if your income is potentially higher than a certain limit, at that point you have to pay more for your Medicare premiums. So what this sheet does is it's just a check. It checks to make sure that you haven't gone into a higher Medicare premium bracket. And if it does, it basically shows you how much you potentially have to decrease your income by to get to the lower bracket. And keep in mind, the primary determination of income now is how much you're converting your Roth, right? So we don't want to accidentally trigger higher Medicare payments. Or maybe we do want to trigger higher Medicare payments. Maybe we're okay with that because we're getting more in tax savings. But let me just give an example. The brackets are decently high. You can see here, we actually have not triggered any type of surcharge here because we haven't converted too much. But let's say if 1 year we converted 300,000. All of a sudden, our annual income for that year was 2028. So remember, one thing to keep in mind for how this works is for this IRMAA calculation, it looks 2 years in advance. So if, for example, your income in 2028 is especially high, when it reaches year 2030, that is actually like Medicare basically looks back 2 years to determine your income. So that's when you're actually going to trigger a surcharge. So in this case, 403,000, your income has reached this bracket here. You're now in bracket 3. And in bracket 3, that results in, I apologize, that was actually bracket 4. It was higher than bracket 3. Your income of 400,000 means all of a sudden you have to pay an amount of 4,504 additional annual Medicare premiums per person. So you can see here, the total additional amount for the year was 4,500 for the husband, 4,500 for the wife, or 9,000 total. And so you're now in bracket 4, as it shows here. And to potentially go down a bracket, you have to decrease your income by $41,000. So what you potentially would want to do is go over here, go down by a bit. And now you're in bracket 3, so that's a little bit better. Your yearly surcharge is a little bit less. So this is just one final potential impact from doing Roth conversions to keep in mind.
Is the Medicare premium determined by adjusted gross income at age 62?
So the way it works is it's basically at any age, it looks 2 years in advance. So for example, if you are turning 70, it will look at your income when you are age 68. So it will look 2 years in advance. Because you first go on Medicare at age 65, the first year it will look at is your income when you're age 63. It will look at your adjusted gross income in that year.
We try to wrap up this section because I think we're almost out of time.
Yes, yeah. So that is actually the summary. It's a couple things here. I think quick disclaimer is this is not precise, if that makes sense. That we don't, for example, include capital gains tax. We don't include net investment tax. So there's other taxes, but this should be generally accurate in terms of estimating your ordinary income tax, which ends up being the rate at which your Roth conversion would be taxed. So I just want to make sure that people are aware that this is like an estimate and you shouldn't rely on it for it to tell you this is what your tax bill is definitely going to be in XYZ year.
Yeah.
Okay.
Hey,
So
in the last 5 minutes, should we just do rapid fire questions? I'm not sure we'll have enough time to cover all the questions, but I'll try to ask as many as I can. What is the latest age one can convert from pre-tax to Roth?
well, you can convert in any year, any age. You can choose to convert. I think the main factor that you want to keep in mind is at some point in time, your RMDs kick in. So that will start to convert for you, if that makes sense. You won't have a choice at that point. There will be mandatory conversions. Now, they're not necessarily high. For example, if you look here, like these conversions aren't too high, mostly because we now have ourselves converting a bunch up here earlier. But you can choose to convert at any age. Or sorry. Let me clarify. There are some penalties if you convert too early. For example, if you convert before 59 and a half, you just have to make sure that you pay the taxes of your conversion from outside of the converted amount to avoid a penalty. But you can choose to convert at any up to any age, for example.
Is there a maximum amount that you can convert each year?
You can convert the entire amount if you want in 1 year. Now, the only thing to that is you probably don't want to. You probably just want to spread it out into whatever years you have lower income. But if you want, you can convert as much as you want in any given year.
Yeah. Is there a way to put the IRA into a trust?
I'll try to take a step back. I'm assuming the reason you want to put into a trust is you're trying to do the conversion and avoid taxes on the conversion, maybe is like potentially the logic behind it. And I just want to be clear that that does not get rid of the taxes on a pre-tax IRA. If you're trying to put it in there for estate tax purposes, then that's a totally separate reason to potentially put it into a trust. But if it's more for avoiding the taxes on the conversion, putting it into a trust doesn't solve that issue.
Yeah. And then we have a question from WeChat. If you sell an investment property 1 year, does this income affect the Medicare premium? So you could just put that in the spreadsheet. I guess you would have to build your own row, but in any gain, it would just bump you into potentially a higher bracket.
Yeah, that's right. So that sale I think it will most likely result in a capital gain if you've held the house for more than a year. And that does get included into your adjusted gross income, which potentially, you see here, there's ordinary income and there's capital gains that does get captured and potentially would bump you into a higher IRMAA bracket for that year.
Okay, great. I know we originally scheduled this for an hour. Do you have any concluding remarks, Nick, to wrap it up?
Yeah, I think for anyone who's about to jump, well, first, I hope this is helpful, and we'll keep on staying on for a bit and answering questions. But I hope this was helpful, and I think one thing that Zhang and I want to do is we want to share this more, to reach more people, to basically broaden the reach of what we're doing, right? Because that way, if we record one video or do one session, we can reach, hundreds. I mean, we already have, it looks like 125 participants, which is amazing. Um, but the more people we can reach, the more impact we have, and we like to do things big. So if anyone has ideas on how we can reach more people and share this with more people so that it's helpful, please let us know. You can let us know in the WeChat group. You can let us know through individual messages, but that's kind of how we're thinking through in terms of like next steps and trying to share this with more people.